and you have this amount outstanding. You send somebody to get the money, obviously not with illegal substances with them or illegal things, but all within the legal procedure, and you have covered the loss with your insurance. What would happen that 34,000, if you look in the first one, that whole 34,000 was insured. That was the risk mitigation. You made the loss, but it was recovered. The frequency was 1, so it only happened 1 in the last 1 month or 1 year, whichever time period you're looking at. Event description, you can put any description that you like within your company, within your organization, within your area. You can implement risk register. Why the loss happened, how it happened, what was the result. It is to make sure that in the future, when you speak to the director or board of director, or the CEO of the company, or present it to if you are the CEO, and you present it to the shareholders, that I need money to raise 30 million rupees to implement risk system. That's how we'll convince them. We've made these many losses, we only recovered this. The frequency is high. If you look at trade finance, which is the 6th one, and you look at the frequency, it's 13. It's a small amount of 6,500, and the frequency is very high. So you look at 6,500 here. I didn't do anything. So if you look at the 6,500, we didn't insure it. We didn't recover it because it was a small amount. We didn't send anyone out to get this amount. We didn't insure it. We thought it's a small amount. Why insure? Administration cost, insurance cost, everything included. We go back to here, and it's 13 times. So basically, it comes more than this. This was the highest loss on our register. But this total goes above that. So what we need to look at is the frequency and how many times the loss is occurring, which area, which department, where it is. And that's how you allocate in the risk register. And this is where you do the risk matrix. So you develop a matrix where you combine high impact, low frequency. So if you go back to our example, high impact and low frequency. These are the risks which can shake your company's cash flow. If you have a huge loss sitting in your daily transaction, your daily P&L will go down, your monthly P&L, your weekly cash flow will go down, your ability to reinvest in the business, your ability to buy, your ability to enhance your business goes down in that period. And that's a huge risk that we are running. Then we have high impact, high frequency. These are called lethal risk. High impact and high frequency. You're losing 1 million every day for the next 30 days. That's high impact, high frequency. Company capital 50 million. You're losing 1/3 of your capital within few days, within a month. So then we move into low impact, low frequency. Low impact, low frequency risk are basically can be ignored, but we still need to pay attention to them because these things, low impact, low frequency, have a habit of moving low impact to this area, high frequency. I'll transit into the real terms of the everyday life. Cash, petty cash. Somebody's taking 50 rupees out for tea every day from the petty cash. You don't notice for a month. 2-3 months later, they'll start taking out 100. They'll check if you respond to it. Then again, somebody else will join them. Now it's a whole group going for tea. Then they move up the ladder, they'll probably have a tea in PC. So now your petty cash will start moving from low impact, low frequency to low impact and high frequency, so it'll be more frequent. And then we'll start going to the PC, you'll go in high impact and high frequency. So, this is just an example that it can move in both directions. So it can move either here, or these are interchangeable. So something from here can suddenly become a high impact and low frequency, but it is very rare. Low impact, low frequency can move to low impact, high frequency. until we check. So it's very important to define those risks in a different category, different area, and say these are the high impact and high frequency, these are low impact, low frequency, so we know where we are making loss. It's a type of a map that will draw the attention of the management, senior management or CEO or the member of the board or your stakeholder, and tell them where to focus their attention, which one to deal first. In the business environment, the most important thing, you have limited time, limited resources. What to do to save your life? Do you need to breathe first or do you need to eat food? Very basic question and very important one for survival. So that's what the question is here, how we are going to do it. And this risk matrix, what it will do, it will not resolve your problem. It's not a magic thing. It will just give you the idea that where you need to focus. And that's what it's all about. Basel II loss distribution approach. Standard statistical techniques are available. Which techniques are most appropriate? What are appropriate for modeling the tail of the distribution? What are appropriate for modeling the tail of distribution? Tail of distribution is another technique of modeling the loss. This is going a bit technical side of the Basel II. General estimation of an operational loss distribution involves three-step estimator frequency distribution, which some of you still remember from your educational days. Estimate a severity distribution, so how severe is the loss. Running a statistical simulation to produce a loss distribution. We'd run a simulation that it happens every Thursday of the month or every Wednesday of the month. We'll simulate it for the next whole month or next whole year and see where it goes. Does it really grow big or does it go small? We need to define the variables, obviously looking at the data that is available at that time over there. If you have any questions at this point, please ask, feel free to ask those questions, or if you want any elaboration, clarification on this. That's the operational risk, operational loss distribution, frequency distribution. These tables, they have a table behind them that is running the table. I wouldn't like to show the table at this point because it's just numbers. So it basically gives you the graphical presentation that how it looks like. Just give you a flavor of what a loss distribution table under Basel II, because Basel II is a standard approach for the financial institution and insurance companies to manage risk, especially operational risk. So you need to have these severity distribution table, frequency distribution table, and also the operational risk area. So you have a severity here, you've got expenditure moving from one way to the other, value of the loss event, and then you have a density of the loss event. So how many you have 10,000 pound losses, how many you have 1,000 pound losses. Loss value is here, so you have very few at low severity of the severe losses are very low. Medium term losses or medium losses are very high. The density at one point, which is peak, this is the area where we need to concentrate, because that's where our major losses are. Or at the tail, how severe loss is, what is the value. So you created the value, you have $1 billion loss, just one loss will be enough to wipe out your company from existence. Same thing here, frequency distribution, again the number of loss events per year and density. So you have March or you have April here, sitting here, or you have February. So you have more losses in January. This is where you need to control. And then going towards December, because everyone is looking at the accounts, people don't make mistakes. They start tidying up things. They start brushing up things under the sofa, hiding it. You have lots of sundry accounts open up, lots of movement in the accounts payable and accounts receivable, delayed invoices. So there are a lot of window dressing techniques that companies have. You have density again here, expected losses, unexpected losses. This is basically defining in two. So this is where we have the expected loss. We predicted these ones before. What's happening here is that it is an unexpected area. So the value of the loss